Welcome to the Deep Dive. This is where we take a whole stack of sources. We're talking research, foundational guides, expert notes, and we synthesize them into the crucial, high-impact knowledge you need.
Exactly.
Today, we are cutting through all the noise in personal finance. We've compiled material covering the four essential pillars you need to build a really robust financial life. We're calling them protection, foundation, defense, and growth.
And our goal for you isn't just to gain knowledge, it's to build a strategy. So many people just rely on, luck or maybe simple budgeting, but real financial health comes from implementing a cohesive strategy across these four areas.
Okay.
So if you can understand these pillars, protection, foundation, defense, and growth, and you make sure they're all working together, you stop playing defense and you actually start building real, durable wealth.
Okay, let's unpack this immediately. Let's start with pillar one, protection. We're talking about insurance.
Right.
And the core question we really need to answer is this. What is the actual difference between a serious life event being just a terrible day emotionally versus it becoming a financial catastrophe that could haunt your family for decades?
And that difference, it is almost entirely determined by informed insurance choices. What's so fascinating here is that it's often misunderstood.
How so?
It's not a payment plan for routine services. It is pure risk transfer. It operates using the law of large numbers, and it's specifically designed to protect you against catastrophic financial losses.
The kind of bill that would ruin you.
Exactly. The kind of event you couldn't possibly cover with savings.
So if I can afford something, I should probably just pay for it myself rather than insuring against it.
Precisely. Look at something like dental insurance. For many policies, the annual premiums actually cost more than your routine cleanings would out of pocket.
Right, that's a predictable expense.
It's predictable, it's manageable. You're often better off just skipping that insurance and paying cash. But what if you face a hospitalization or a potential cancer treatment that could easily run into 6 or even 7 figures?
That's the catastrophe.
That is the catastrophe you absolutely must protect against.
Speaking of health insurance, let's talk about the essential safeguard everyone needs to understand. It's the out-of-pocket maximum. It's your financial parachute.
It is. It's the absolute cap on your annual spending. Once you hit that out-of-pocket max, the insurance company covers 100% of all subsequent covered expenses for the rest of that year.
So that number is everything.
It's the most crucial number on your policy because it tells you the absolute maximum amount of money you can lose in a truly disastrous year. It gives you defined risk.
But the sources we looked at remind us that hitting that cap isn't always easy or automatic, which brings up all those bureaucratic speed bumps we all face.
Right. You have to navigate things like pre-authorization requirements. The insurance company needs to give prior approval before you get certain expensive procedures or medications.
And if you don't?
If you fail to get that bureaucratic sign-off, the claim can be denied. And you're left holding the entire bill, even if the service was technically covered. It's a painful lesson in reading the fine print.
Let's shift gears a bit and talk about protecting your assets against liability risks. So the risks you pose to other people.
This brings up a really important question about auto insurance.
Yeah.
You see so many people who just carry the state minimum required auto liability coverage.
To save money, presumably.
To save maybe $20 a month, yeah.
Yeah.
But this decision is profoundly penny-wise and pound-foolish.
Why is it so dangerous?
Because today's medical costs are astronomical. I mean, in a serious accident, minimum liability limits, which might be, $25,000 or $50,000, they're exhausted almost immediately.
And then what happens?
Once those limits are hit, the injured party can sue you directly. You become personally liable for all the excess damages. You're exposing your home, your savings, your future wages, all to save a negligible amount on premiums.
That completely reframes the cost of a premium. It's a small, predictable cost to avoid a massive, unpredictable loss.
I did.
And that leads us to two essential, and I think often overlooked, types of protection that really shore up this base. The first is disability insurance.
The statistics on this are just shocking. They completely defy our perception of risk. A typical 35-year-old worker has a 25% chance of becoming disabled for 3 months or longer before they retire.
A 25% chance.
Yes. And this is a massive double financial threat. Your income stops entirely while your expenses. They could potentially increase sharply because of healthcare or other needs.
So when someone goes to buy disability insurance, they often see this distinction between own occupation and any occupation. Why is that wording so critically important?
This is where the technical detail matters more than anywhere else. Any occupation coverage only pays benefits if you can't perform any suitable job.
Any job, like flipping burgers.
Based on your education and experience, yes. So if you're a specialized professional, like a surgeon or an engineer, that's not really protection.
Okay, so what's the alternative?
Own occupation coverage. It pays benefits if you cannot perform the specific duties of the job you held when the disability occurred.
So if I'm a surgeon and I get tendinitis in my hand, I can't do surgery, but I could still teach. With any occupation coverage, the insurer could say, go teach, and deny the claim.
Correct.
But with own occupation, I get paid because I can't do the specialized job I was trained for.
Exactly. It protects your chosen career path and the massive investment you made in that specific skill set. Always, always favor own occupation if you're in a specialized high-income field.
The second, and maybe the most undervalued protection, is umbrella insurance. I mean, the price-to-coverage ratio on this is just remarkable.
It is the ultimate asset protection firewall. It's incredibly affordable, often between, say, $150 and $300 a year for $1 million in extra coverage.
And it sits on top of your other policies.
It sits above the liability limits of your auto and home policies. So if those limits are exhausted, the umbrella policy kicks in. Plus, it often provides broader coverage for things like legal costs from claims of libel or slander.
So if you have significant assets, or you expect to earn high future wages,
It's non-negotiable.
that wraps up our protection pillar. So once we're protected from catastrophic losses, we need to make sure the money we do have isn't leaking out unnecessarily. Which brings us seamlessly to Pillar 2, the foundation, your optimized banking setup.
The checking account is the transactional command center. But these command centers, if you don't manage them, can be huge sources of loss.
You mean fees?
Fees. We see traditional banks charging $10 to $15 a month if minimum balance requirements aren't met. But the truly devastating wealth destroyer, overdraft fees, they can hit for $30, $35 an incident. These fees are just, they're friction. They erode your wealth for the privilege of accessing your own money.
And once we get past those transactional issues, we run directly into what our sources call the savings trap.
Yes, the vast majority of people have their cash reserves trapped in accounts that are literally losing money every single day.
You're talking about standard savings accounts.
A traditional savings account at a big bank often pays, what, 0.01% APY? That means $1,000 earns 10 cents. Annually. You are losing purchasing power to inflation daily.
Okay, so contrast that with a high-yield savings account, an HYSA.
These are generally offered by online banks, and they can currently pay anywhere from 3 to 5% APY, depending on the interest rate environment.
The difference between 0.01% and, say, 4% might not sound huge emotionally, but the financial difference is enormous.
It is enormous. Let's look at that memorable detail from the research. Over 10 years, if you keep $10,000 in an HYSA earning 4% APY versus that traditional 0.01% account, the difference in earned interest is approximately $4,800.
Wow. Almost $5,000.
Nearly $5,000 of pure growth just from making a 5-minute decision to switch accounts. That's not negligible. That's a vacation. That's a major repair bill.
So once that emergency cash, your 3 to 6 months of expenses, is secure and liquid in an HYSA, what about money you won't need for, say, 2 to 4 years, like a down payment or next year's tuition?
That's when you start optimizing liquidity versus return using certificates of deposit or CDs to lock in higher guaranteed rates.
But they lock your money up.
They do. That's why we recommend the strategy of CD laddering.
How does that work practically for someone listening?
Okay, so you divide the cash reserve you won't need right away, and you stagger the maturities. Instead of putting everything into one 5-year CD, you open CDs that mature sequentially.
So like a 1-year, 2-year, 3-year.
Exactly. A 1-year, 2-year, 3-year, 4-year, and 5-year CD. Each year, one CD matures. That gives you the option to use the cash if you need it, or reinvest it into a new 5-year CD at the top of the ladder, keeping the whole thing moving.
That's smart. It balances the higher returns with predictable annual liquidity.
Perfectly.
And finally, before we leave the foundation, we have to talk about maybe the most powerful savings vehicle available to many people, the health savings account, or HSA.
Yes. If you're eligible, which means you have a high deductible health plan, the HSA offers a triple tax advantage that nothing else in the tax code provides.
Okay, break that down.
1, contributions are tax deductible, so they reduce your taxable income today. 2, the money grows tax-free, just like a Roth IRA. And 3, withdrawals are completely tax-free if you use them for qualified medical expenses. Anytime.
But the real kicker is its retirement function, isn't it?
Absolutely. If you can manage to keep that money invested and you don't spend it on medical costs until retirement, after age 65, it functions just like a traditional IRA or 401k. Meaning you can take withdrawals for any purpose, not just medical, and you'll only pay ordinary income tax on those non-medical withdrawals. It's the ultimate financial safety net and retirement accelerator.
Okay, that's a rock-solid foundation.
Yeah.
Now, on to pillar 3. Defense. Because all the optimizing and insuring in the world means nothing if we ignore that relentless financial menace. Inflation. The invisible tax.
And to connect this to the bigger picture, you have to realize inflation isn't an accident. It is the intentional, stated policy goal of central banks. They target 2% annual inflation.
So my dollar is designed, by policy, to buy less tomorrow.
That's right.
So what happens when that 2 or 3% runs unchecked over a lifetime?
Well, the devastating power of compounding inflation means that at just 3% annual inflation, money loses half its purchasing power in 24 years.
Half, in less than a quarter century.
Think about that. The real value of any cash you hold is cut in half. This is the silent destroyer of cash savings.
And many of the sources we looked at argue that the official measure, the CPI or Consumer Price Index, might not even be accurately reflecting our personal experience of inflation. Why is that?
That is a critical detail. The CPI tries to measure the cost of a basket of goods, but the methodology uses techniques that tend to, well, suppress the official number. For example, they use substitution.
Substitution.
They assume if the price of, say, expensive beef rises, consumers will simply switch to cheaper chicken. So they adjust the overall cost of living downwards.
Wait, they're assuming away my steak dinner. That's a huge assumption.
It is. They also use what are called hedonic adjustments. If a computer costs the same as last year but has a better processor, they argue you're getting more value for your money. So the effective price of computing has gone down, even though you paid the exact same nominal price.
Which means the official number might be lower than what people are actually feeling in their wallets.
It often understates the actual cost increases for the average household's fixed consumption patterns, yes.
Okay, now let's talk about inflation's paradoxical impact on debt, because this is one of the most fascinating aspects of finance.
Inflation is the debtor's friend for fixed-rate debt. Think of a 30-year mortgage. You borrow money today when its value is high, and you repay that loan over the next 3 decades with dollars that have less and less purchasing power.
You're paying it back with cheaper dollars.
You're effectively paying it back with cheaper dollars, but I assume you know the opposite is true for variable rate debt.
Right. It becomes the debtor's nemesis.
Exactly. For things like credit cards or adjustable rate loans. When central banks raise rates to fight inflation, the interest costs on that variable debt just aggressively rise. It makes it dramatically more expensive and harder to pay down.
So what does this all mean for the core defense strategy against inflation?
It means cash is inflation's primary victim. If your traditional saving strategies rely on cash and low-yielding bonds, those become wealth destruction strategies when inflation is higher than your return.
So the solution is?
The core defense is to invest in assets that historically appreciate with, or even outpace, inflation. We're talking about stocks and real estate.
That is the perfect launch pad for our fourth and final pillar, growth. We have to address this fundamental confusion head-on. Saving and investing are not interchangeable terms.
They are absolutely not. They serve different masters and they have different goals.
So how do we define the distinction?
We use the time horizon rule. Saving is for your short-term needs, an emergency fund, or goals less than 3 years away. The priority there is absolute safety and liquidity. You have to accept a low return.
Okay, and investing.
Investing, conversely, is for long-term goals. Retirement, goals 5 or more years away. Here, the priority is growth and high returns, which requires you to accept risk and volatility.
So if the goal is coherence, why do people constantly confuse the two? Why do they save when they really should be investing?
I think it's psychological. The fear of volatility is it's deeply ingrained, but avoiding that risk comes at an incredible, invisible cost.
Let's see the math on that.
Okay, look at the math. Let's say you contribute $500 a month for 30 years. If you save that money at 1%, you end up with about $210,000.
Okay.
But if you invest that same amount consistently at a conservative long-term 7% return, you end up with over $600,000.
That's a $400,000 opportunity cost, just from a behavioral aversion to necessary risk. That is the price of fear.
It truly is. The fear of losing 10% in 1 year prevents people from capturing that 7% average return over 30 years.
Let's tie this all together. Give the listener the 4 steps to implement this integrated strategy, moving from protection all the way to growth.
It's a clear hierarchy. 1. Fund protection. Get your essential insurance locked down, health, disability, and umbrella.
Step 1. Done?
2. Establish your foundation. Fully fund that emergency fund, 3 to 6 months of expenses, and put it securely in an HYSA. 3. Drive growth. You target tax-advantaged accounts first. Get your full 401k match, max out your HSA, fund your IRA, maximize that tax shield before you even think about taxable brokerage accounts.
And the final step for most people?
Yeah.
I'm guessing it's about simplicity.
4. Stay simple and low cost. Invest using broad-based, diversified index funds. These funds just track the entire market, which historically returns 7 to 10% a year after inflation, and they are inherently low cost. And automate all of it. Discipline beats genius every single day.
Automation is so key because there are 2 critical mistakes fueled by cost and emotion that consistently destroy investor returns. The first one is letting fees just erode your capital.
That 1% annual fee, it sounds so tiny, but the effect of compounding fees is insidious. A 1% annual fee on your investments reduces your final wealth by about 25% over 30 years.
A quarter of your money.
A quarter of your potential retirement money just vanished into management costs.
And the second mistake is the behavioral one, trying to be smarter than the market, timing it.
Emotional selling during a panic and euphoric buying at market tops. It destroys wealth. Successful investing is not about getting lucky or picking the exact right moment. It requires time in the market and maintaining discipline during that inevitable volatility. Consistency beats complexity, always.
So we've built a powerful financial framework today. It's built on 4 solid pillars: protection through insurance, foundation through optimized banking, defense with an inflation strategy, and finally, growth through disciplined investing.
You now have the knowledge to build a really robust financial life, one that's secured against catastrophe and optimized for long-term growth. Just remember, the best financial decisions are targeted, they're efficient, and they are consistent.
And to leave you with a final provocative thought for exploration that builds on our discussion. Since we know inflation intentionally reduces the real value of fixed-rate debt over time, consider this. How could maximizing the fixed-rate mortgage on your home, taking the longest term you can afford, be viewed as a powerful strategic wealth-building tool? It would allow you to pay back that loan with increasingly depreciated future dollars, all while your invested assets work hard to outpace that very same inflation. Something to mull over as you build your lasting strategy.